Welcome to the deep dive. Today, we're cutting through the complexity of some corporate reports.
Yeah, trying to unearth the real story, right?
Exactly. Behind Motherson Sumi Wiring India Limited's latest financials, we've really dug through their investor presentation, the official press release.
And that earnings call transcript, too. Some
Yeah.
fascinating bits in there with management and analysts.
Definitely. All to bring you what truly matters. So today, we're taking a deep dive into MSYL's first quarter financial results for FY26. That's April to June 2025.
And our mission really is to unpack the key highlights, try to understand what's driving the numbers.
And figure out what these figures actually mean for the company's future and, well, for you listening. Okay, so let's unpack this. MSY reported some pretty impressive revenue growth for Q1 FY26.
Yeah, the reported revenue hit, what was it, RS 2,494 crores for the quarter? Strong number.
Very strong. And what's particularly eye-catching is that this is a robust 14% year-on-year growth.
Which is quite something.
And here's the kicker, really. The overall passenger vehicle industry, in the same period, it only grew by about 3%.
Just 3%. So that contrast really tells a story. They're definitely outpacing the market.
Yeah.
And what's truly insightful here is how they're doing it. It's not just like selling more widgets.
Right.
MSY is significantly increasing their content per vehicle, basically the value of their wiring harnesses inside each new car model.
Ah, okay. So more value per sale.
Exactly. And this isn't just a temporary sales bump. It signals these really deep, kind of sticky relationships with the automakers. It means they're locked in as a preferred supplier for critical new platforms.
That's a powerful position to be in, a strategic moat, like you said.
Definitely. And just to give a bit more context on that revenue number, if we actually exclude the new greenfield projects, the figure was RS 2,338 cores,
Okay.
which still represents a solid 7.2% growth year on year. Yeah. So, their core business is performing robustly too.
So they're securing more orders, and each order is getting more valuable for them. That sounds like a great financial tailwind for future revenue.
It should be, yes.
But here's where it gets, well, maybe a bit more nuanced, the part that caught my eye. While that revenue soared, the reported net profit, the PT profit after tax, that was Rs 143 crores for the quarter, which is actually a slight decrease from the Rs 149 crores in Q1 of FY25.
Right.
So that's a classic head-scratcher.
Right.
Revenue up strongly, profit slightly down. What's causing that divergence?
Yeah, it looks odd on the surface. But if we connect this to the bigger picture, the profit story becomes much clearer when we look at the figures ex greenfields.
Ah, okay. Excluding those big new factory investments.
Exactly. Their ex greenfield PT, so profit without those startup costs, actually reached 169 crores.
Okay, so that is an increase then.
It is. It's up from Rs 162 crores in Q1 FY25. So that shows a healthy 4.3% growth in the underlying business profit. This is, the classic invest to grow playbook. One of the U greenfield plants did start production in Q1 FY26, contributed about Rs 156 crores to revenue.
Which is good.
Yes, but these new ventures, they incurred what the company calls greenfield-related net startup costs. And those were Rs 31 crores in this quarter.
31 crores, okay. And how does that compare?
Well, it's up from Rs 17 crores in Q1 last year. So that increase in startup cost is what's currently hitting their reported profitability.
Oh, got it.
The Rs 31 core cost isn't just, an expense line item. It feels like a calculated strategic sacrifice by management.
Investing for the future.
Right. They're betting on future market share, future efficiency gains from these new plants. It speaks volumes, really, about their long-term growth appetite, their confidence, even if it means a short-term dent to the bottom line right now.
Understood. So it's very much a strategic investment weighing on the reported numbers, not some kind of decline in their core business profitability.
Precisely.
And on that note, the earnings call also flagged a sharp jump in staff costs. What's driving that? Is it just these new facilities or something else? Is it related to these expansion plans?
Oh, it absolutely is. The increase in staff cost is largely because they're hiring manpower for these expansion units, but they're hiring them before full production starts.
For training, you mean?
Yeah, to train and upskill them before they hit the actual production lines. And this is especially relevant because, as management noted, some customer production plans have actually been deferred slightly.
Ah, okay. So they have the staff ready, but the volume isn't quite there yet for some lines.
Exactly. But management did reassure analysts that as these programs commission, as the volumes really kick in, staff costs should normalize. It's an upfront investment in people, basically. preparing for the growth they expect.
Right. And it's a significant number of people, isn't it?
Potentially, yes.
Yeah.
They mentioned that when all 3 new plants are fully operational, they could require something like 7,000 employees in total across them.
Wow. Okay. That brings us nicely to their strategic growth areas then, particularly electric vehicles, EVs. The whole industry is shifting.
It sure is.
So what does their current EV share tell us about how they're positioning themselves for this, well, this massive shift, especially thinking about that content value idea?
Right. So EVs accounted for 5.4% of their total revenue in Q1 FY26. Not huge yet, but growing.
Okay.
But the key insight for management, and this is important, is that the content value in EV programs is much higher, about 1.5 to 1.7 times higher in passenger vehicles compared to your traditional petrol or diesel cars, the ICE vehicles.
1.5 to nearly 2 times the value per car. That's significant.
It really is. It means every EV program they win is inherently more valuable to their top line.
And what about the profitability of these EV programs? Is it as good straight away?
Well, they said profitability for new EV programs starts at, let's say, a certain level, but it's expected to improve as the volumes ramp up and as more design changes, more complexity perhaps comes into the vehicles. So it's a ramp up on multiple fronts: revenue contribution, volume, and then profitability catching up.
It sounds like they're definitely positioning themselves well for that future. But you mentioned ramp-ups, and the chairman himself noted some delays in these crucial greenfield projects.
Yes, that came up on the call.
Given how central these seem to be for MSYL's growth strategy, how significant are these delays for their overall timeline? And are there any financial repercussions or maybe even strategic shifts they might be thinking about because of them?
That's a great question, and it really highlights the real-world complexities of scaling up production like this.
Sure.
Okay, let's break down the status they gave. The Navagam plant in Gujarat. EV production started there in Q1, and it's ramping up now in Q2. Good news there.
Right.
However, the combined EV plus ICE project start of production, the SOP, that's been delayed. It was meant for Q2. Now it's looking like Q4 FY26.
Okay, couple of quarters delay there. What about the others?
The Karkata plant in Haryana, that's an ICE project, that seems to be on track for Q2 FY26, so this current quarter.
Good.
And then the Pune plant in Maharashtra. The EV plus ICE project there has actually been operational since Q2 of last fiscal year, FY25. And the pure EV project there started in Q4 FY25, with its volume ramp-up happening now in Q2 FY26 as well.
So a bit of a mixed bag on timelines. How is the company viewing these delays? Are they seeking compensation from customers or suppliers?
Their perspective, or at least what they communicated, is that they view customer relationships as these really long-term partnerships, not just short-term transactional things.
Building trust.
Exactly. So seeking compensation for delays isn't their immediate focus. It's more about maintaining that long-term trust, positioning themselves for future programs with those same customers.
Makes sense strategically.
Yeah, the chairman specifically called it a work in progress. He mentioned needing patience, as the whole industry and the government work through some tricky issues. Things like the import of rare earths and magnets, which are crucial for EVs.
Patience, indeed. That work in progress comment, especially mentioning rare earths, really underscores the complexity of scaling up manufacturing in India right now, particularly with these global supply chain dependencies.
Absolutely.
So with all these huge investments, the greenfields, the EV capacity, you'd maybe expect their balance sheet to feel some strain.
You might think so.
How are they managing to keep such a strong financial position, particularly their debt levels, amidst this pretty aggressive expansion? Is there any risk maybe looming given those deferred customer plans or potential ramp-up challenges we just talked about?
It's a very astute observation. And quite impressively, they continue to maintain a very strong financial position. They are still effectively debt-free.
Really? Even with all this spending?
Yes. Their net debt figure was actually negative Rs, 16 crores as of June 30th, 2025.
Negative 16 crores, meaning they had more cash than debt.
Exactly. Cash exceeded external debt. And that's actually an improvement from the end of March when it was negative Rs, 5 crores. So it indicates really robust liquidity, good cash flow management, financial prudence, which is obviously crucial when you're navigating these large-scale investments and potential bumps in the road like delays.
That strong financial footing is definitely a major positive, maybe even a relief, especially with some of the current economic headwinds out there.
Agreed.
Speaking of external factors, we've seen copper prices bouncing around quite a bit. How insulated is MSWEL from those movements, given the sheer amount of copper they must use? And what about, say, volatile currency markets?
Good points. We have seen an upward trend in copper prices recently. LME copper averaged USD 9,519 per metric ton in Q1 FY26.
Which sounds high.
It is relatively high historically. However, and this is crucial, the impact of copper prices on AMSOIL typically has about a one-quarter lag.
Okay.
But more importantly, it generally neutralizes over, say, 3 to 4 quarters. And the reason is they have a pass-through arrangement with their customers.
So they pass the cost increase or decrease along eventually.
Essentially, yes. The cost fluctuations are largely passed through, so it hedges that risk significantly.
Right.
And yeah, they also mentioned, the usual fluctuations in exchange rates, Japanese yen, US dollar, euro, which they just manage as part of their regular treasury operations.
So the big commodity price swings are largely mitigated by their customer agreements. That's a key de-risker for them.
It is. Very important for their business model.
Okay, finally then, what's the broader market outlook that management is seeing? What are they saying about the coming quarters, especially concerning customer demand and maybe future projects?
Well, management projects that the full year FY27 should be positive overall, though they did say more clarity will probably emerge in the second half of this fiscal year, FY26.
Yeah, okay.
They noted Q1 is typically a bit subdued for the auto industry. Two-wheeler volumes were kind of flat. Commercial vehicles didn't grow much.
Right.
However, they do anticipate good growth in the two-wheeler segment, specifically in Q2 and Q3, mostly driven by, the upcoming festival season in India.
The festive demand bump.
Exactly. And they also stressed they're actively working with customers on new model launches. That's happening in both the two-wheeler and the commercial vehicle segments, which obviously points towards future demand pipeline.
And are they still planning to invest heavily? What about CapEx?
Yeah, they estimated their CapEx for this full fiscal year, FY26, to be around Rs 200 cores. And they said that's based on customer projections. So it indicates continued investment, but aligned with what their customers are signaling in terms of growth.
Okay, so let's try and recap this. We've seen MSW Weil not just outperform the wider market with really strong revenue growth.
Driven by that higher content per vehicle.
Right, but also strategically investing heavily in these high potential areas like electric vehicles and the new greenfield facilities.
Even though that's causing some short-term pain on the reported profit line due to startup costs and dealing with some ramp-up delays.
Exactly, and they're doing all this while, remarkably, maintaining a robust, debt-free financial position and largely de-risking themselves against external factors like copper prices.
Which, this really raises an important question for you listening. Given AMSOIL's clear strategic investments in these new greenfields and the whole electric vehicle segment, even with that short-term hit to reported profitability and the challenges in getting everything ramped up perfectly on time, what does this really tell you about their long-term vision, their commitment to shaping the future of the automotive supply chain?
Yeah, and building on that, how might these calculated short-term impacts on profit actually be paving the way for a much more dominant position for them in the future? Especially as that EV market truly matures and these massive new production lines get fully up and running. Something to think about, definitely, as the strategy continues to play out over the coming quarters.